Welcome to Seven Bulls. We break down finance so that anyone can understand. Roll the intro. Hello, fellow investors. Welcome to Seven Bulls. Over the past few years, healthcare insurance giants have struggled in the stock market. For an industry that's typically considered defensive and stable, many investors are asking, why have these names been underperforming and what will it take for them to recover? Will they recover? Today, we're going to dig into what's been weighing on these companies, what could turn things around, and whether this downturn might actually be setting up long term opportunities for investors. Before we get started, don't forget to hit the like button and share this video with anyone you know who's interested in this type of content. It really helps the channel grow and helps us get into the algorithm. Also, I wanted to tell you guys about our platform of finance software, the Pro Series Equity Valuation Software. It's a suite of easy to use projection models designed for stocks, real estate, and even retirement planning. These are tools that we personally use at Seven Bulls to accurately value companies. If you've ever wanted to get a quick but powerful sense of value and long term projections, we have officially started to provide our tools to the everyday investors. Why should the institutions have the upper hand? I'll leave the link at the bottom of the video, so make sure you check it out after watching. Now, let's talk about why these healthcare insurers have been struggling. One of the biggest headwinds has been rising medical costs. Inflation has hit hospitals, labor, and prescription drugs, and insurers have had to cover those higher costs without being able to raise premiums fast enough. For example, UnitedHealth recently highlighted that utilization rates, meaning how often patients go to the doctor or get procedures, have been much higher than expected post COVID. More elective surgeries are coming back, and that's cutting into margins. Another major factor is government pressure on pricing. Companies like Centene and Molina get a large portion of their revenue from Medicaid and Medicare Advantage plans. These programs are highly regulated, and reimbursement rates are set by the government. When Washington cracks down on spending, insurers feel it directly in their bottom lines. That uncertainty around government healthcare budgets has created volatility, especially with debates around Medicare Advantage overpayments. CVS is a good case study here. They've shifted heavily into becoming a healthcare provider, buying Aetna, and investing in primary care clinics. But while the strategy is bold, integration costs and competitive pressures from companies like Amazon and Walgreens have dragged the stock lower. Investors worry CVS may be stretching itself too thin in a tough environment. So, what could lead to a recovery? First, stabilizing medical costs. If inflation in healthcare moderates and utilization trends normalize, insurers could see margins improve again. United, for instance, still has one of the strongest balance sheets in the sector and a diversified model with Optum, its healthcare services arm. That business has been a growth engine and could help offset insurance volatility. Second, policy clarity. A lot of the fear in this sector comes from not knowing what future regulation will look like. If there's more stability in how Medicare Advantage rates are set, investors may feel more comfortable re entering the space. Centene, which has been restructuring to focus on its core Medicaid and marketplace business, could be well positioned if the political environment stabilizes. Third, long term demand. Despite short term headwinds, the healthcare insurance market has one undeniable tailwind: an aging U.S. population. More people are entering Medicare age every single day, and private insurers play a huge role in providing those benefits. Molina, for example, has thrived in the Medicaid space, and demographic trends still support its long term growth. At the end of the day, these companies are navigating short term challenges, but sit in a sector that is essential and backed by powerful demographic forces. The next few years will depend on whether they can adapt to rising costs, regulatory shifts, and new competition. If they succeed, today's beaten down prices might look like a rare buying opportunity. So, what do you think? Are these insurance giants value traps, or are they misunderstood long term winners? Drop your thoughts in the comments. I'd love to hear your take. And don't forget to check out the Pro Valuation Tools platform using the link below to take your own analysis even further. Remember, keep up with your financial education. You're the only one in charge of your future. Be safe.
Seven Bullies.